Rich T, Richard Tartaglia, back on the show again, early in the year 2018. You're not cold?
I'm good.
You're okay?
Solid.
You sure?
Let's get this nice sunlight warming me up.
Yeah, it's nice. So in the hip hop community, he's known as Rich T. Just to let you guys know.
From the west side.
Yeah, but that wasn't the intro. That was just. Hey guys, what's up? It's your man Pete, and it's our second video of 2018, and I've got my good man Richard Tartaglia here from the Vine Group, because he seems to have a really good grasp of what's going on in the economy, interest rates. You know, are we going to have any other sort of regulatory changes like the OSFI one that was announced last year and began implementation in January 1st. So we're going to ask him some questions to sort of gauge him what he thinks is going to happen in the market. So what do you think will be the single biggest factor to affect the market this year? Is it going to be interest rates, or is it going to be you think something else is going to happen in the government's side of things in terms of policy? What do you think is going to affect the market?
The biggest thing I think affecting the market in 2018 would be the January 1st changes. Basically, all uninsurable mortgages are needing now to qualify at the greater of the contract rate plus 2% or benchmark rate, whatever the greater of those two, that's your qualifying rate.
Okay, so who's the most at risk right now because of those changes? Like what type of client are we talking about that's going to be at most risk right now?
So it's going to be those clients that have 20% or greater of a down payment. Those are the ones that are really being stress tested. The high ratio clients with less than a 20% down payment, those clients have already been stress tested since October of 2016. So now that 2018's here, January 1st, it's the conventional mortgages, the uninsurable mortgages that are really being affected.
So how about the interest rate hike that we saw? Like how is that going to affect people who are, you know, first-time home buyers? Because we've had 3 increases in the last 7 months, and before that we had, you know, none from the Bank of Canada for like 7 years or something like that, right?
Yeah. So as of January 17th, the government increased their their overnight interest rate by 25 points. The banks relayed that interest rate increase directly into their prime rate. So all of prime rates increased by 25 points. Prior to that, the 2 last increases in 2017, the banks increased their prime rate by 15 points. So now it's actually been more felt in the market because of the banks being succinct with how they've increased their prime rate across the board.
Okay.
Actually, insured mortgages, those high ratio mortgages, those mortgages are getting very good interest rates in today's environment. We're seeing those as low as 3.04, 3.09,
wow,
3.14.
Okay.
Those high ratio mortgages, they're really getting those lower rock bottom rates because they're insured by the CMHC, Genworth, or Canada Guarantee, and therefore the lender is not at risk. So they've mitigated their risks by having the mortgage be insured, and they're willing then to put offer a lower interest rate.
That's interesting. Okay, so essentially what we're saying is that potentially it could be a good opportunity for first-time home buyers to be in the market this year who don't have as big of a down payment to work with, as long as you're okay with an insured mortgage, right?
Yep. As long as you're okay with the premium that you'd pay for an insured mortgage.
Right. And I mean, if we are expecting to see somewhat a softening or a dip in the market, maybe sellers are going to be a lot more realistic in terms of what they want to sell for. So it could potentially be a good combination for first-time home buyers in the city. Start looking early, guys, and make a move before everyone else does. So are we still seeing a lot of investors sort of refinancing right now, Rich, and you know, investing in more property, or do we see it more like they're offloading their property?
Yeah, I think overall confidence in the real estate market it's still there. Those that can hold on to properties are holding on to properties. I have a lot of deals I'm working on right now where they're upsizing. So moving from maybe a condo or a townhouse to a larger detached home.
Which is a great year to do that, because you'll get a good price probably on your condo or townhouse, and then the market's a little bit softer for the detached market, right? It's a good year to move on that.
So we're seeing a lot of equity takeouts, to acquire a new property, but you want to make sure you talk to a trusted mortgage broker that is able to position that with the appropriate lender, because rental income is looked at differently from each lender to another. And once you get to a couple properties, things can really tighten up, and you want to make sure that you're not going to be hitting a financing wall at the 3-4 property mark.
Right.
Because of how ratios work with the way that rental income is looked at versus debt.
Right. So 3 or 4 is sort of that area where they don't really want to be lending to you.
Well, yeah, I mean, the banks have policies where they'll say, you have 5 properties. We will not lend to you anymore, period. Regardless of income, regardless of equity, regardless of their net worth. That's the financing wall. The big 5 banks have property limit policies in their lending guidelines, or door limits. So if you have a triplex that's 3 doors, you're reaching your financing wall with that lender. The banks do this because they're so exposed to real estate on the mortgage side and their infrastructure side that they don't want to take on additional clients that are at risk in the real estate market.
So is it possible for banks to see how many properties you own? If, let's say, for example, you get a mortgage at Scotia, then you get a different mortgage at RBC, then you get a different mortgage at like Street Capital or something like that. Because I remember years ago they used to say that they weren't able to access other banks' records or whatever to sort of figure out how many properties you actually own. Where are we standing on that these days?
We're required to disclose any property that we know of in the form of our licensing. We're regulated as well, so we do disclose that to whatever lender that we're lending to.
Okay.
It'll show up on their credit bureau. Any liability that's on the client's profile, we will disclose to the new lender.
Right.
But it's about finding the lenders that will look at those liabilities as favorably as possible. Rate is important, but I think the most important aspect of growing a real estate portfolio for investors is be prepared for what potential new changes could be coming. Get access to your equity now, and we saw a lot of that at the end of last year before the new rules changed. A lot of refinances, people getting access to their equity. Can
you say on camera which types of lenders are more inclined to lend to you, even though you're holding more properties?
There's great lenders that follow different types of rental income guidelines. So there's great credit unions out there that will take 100% of rental income.
Right.
Desjardins does that. You have ICICI Bank that does that. B2B Bank they're called debt coverage ratio lenders.
Okay.
So they'll look at the total amount of rental income coming into the portfolio, and they'll offset the heating costs, insurance costs, versus just a lender that's doing an offset. So Scotiabank does a 50% offset to rental income.
Yep.
Meaning that basically you take a DCR lender versus versus an offset lender. Usually the DCR lender is going to lend more.
Okay, so if you guys need some more information about that, if you're an investor and you want to try to double down or triple down this year, then you definitely want to give Rich a call there. Okay, guys? Okay, so I'm going to do a quick math round with Richard, because I think he's definitely a lot better at numbers than I am. The Asian stereotypes actually don't apply here. So, for example, if somebody was a first-time home buyer and they had $100K in cash, right, that they wanted to use as a down payment, and they wanted to buy something that was $1 million. Okay, let's just say that. So they're at a 90% loan to value. How would the OSFI changes affect them, if any, and how would the interest rates affect them? So would they still be able to qualify, or would they have to come down to, say, an $800,000 property now instead of $1 million?
So 90% loan to value, 10% down payment. New OSFI changes do not affect.
Okay.
Period.
Okay.
So first-time home buyers, they think they're getting priced out of the GTA because of all the news in the media. Things haven't changed.
But they're still being stress tested at what rate?
They're being stress tested at the rate plus 2%. Their contract rate plus 2%, but their contract rate plus 2% is lower than the benchmark rate. So they're already being stress tested at the benchmark rate prior since October 2016.
Okay.
So things have not changed for them.
I mean, I guess you would need to have pretty high income though still to be able to qualify based on the stress test, right? So like what kind what kind of income would you be looking at monthly with no debt? Let's say no debt, right? What kind of income would you be looking at monthly to be able to afford $1 million property with 10%
a high ratio?
down? Yeah.
You're going to need at least, so times 5 usually for a high ratio mortgage. So gross family income of at least 150, 175.
Okay, yeah, that sounds like your sort of typical young professional, like
Yeah, I mean,
lawyers, accountants and so forth, right?
Yeah.
So it's definitely not out of reach. It's just a matter of getting your finances and your down payment in order, right?
Exactly.
So how much of an impact is that on the monthly mortgage right now with the rate increases? Like how much more would somebody be expected to pay on a monthly basis, do you think? Based on the same scenario? Yeah.
So again, insured mortgages, different rates, a lot better rates than your uninsurable mortgages. So payment hasn't changed drastically just because rates have increased. You may, on a mortgage like that, you may be forking out an extra $150 a month because of rate increases.
Okay. That's not bad between two people, right?
Just off the top of my head.
Yeah, better than what I can do. Based on the language from the Bank of Canada and sort of what's happened right off the bat in January with the rate increase, would you say people should lock into a 5-year fixed, or should they still take a gamble on the variable option?
The general tone of the government has been that wages are increasing, not substantially. The economy's doing well. Oil prices have increased. Economy's generally doing quite well. So as of January 17th, they increased rates. Next rate increase is, actually no, it's March 7th, the next increase. April 18th is the next Bank of Canada outlook on the Canadian economy. So they'll forecast the year and give us a new update.
Have they already decided they're going to increase it again?
No, they haven't. That's when they're not going to announce the next decision as to whether they're going to keep it the same or increase it.
Right.
Variable versus fixed is...
Same scenario, the high ratio,
Okay.
90% loan to value.
Yeah.
What should they do?
It's really up to the client. If they're okay, sleeping at night with variable rates. Variable rates offer you an exit strategy. If you're looking at potentially selling the home at the 4-year mark, you shouldn't sell before 5-year. I mean, depending on what your situation is. There's a lower penalty on a variable mortgage than there is on a fixed.
Okay.
So there are some advantages of going variable. You can always flip a variable rate mortgage into a fixed at no penalty throughout the term. But fixed rates may just give that client an extra bit of comfort and sleeping at night. So really, that I kind of leave up to the client. I go through the numbers, go through the payment differences, and discuss the risks. But at the end of the day, it's about the client's risk tolerance. But yeah, general tone of the Bank of Canada is that fixed rates would be a good bet.
I get the sense that a lot of people are trying to lock in this year because of a lot of uncertainty, and I think there's going to be a rush into the market pretty early to try to get rates and lock them in, and figure out where they're going to live as soon as possible, so that they don't have to deal with the uncertainty that's going to happen throughout the year. So is that the same sentiment that you're getting?
Yeah, generally people, I have a lot of clients locking in because they're afraid, but I still have clients taking variable. So
yeah.
When it comes to fixed versus variable, I recommend look at your portfolio as a whole. If you have a rental property with a variable rate on it and you're buying a primary residence with a fixed rate, maybe your overall allocation of variable versus fixed is 20% variable, 80% fixed. Overall, you're less of a risk taker than you are, a risk taker.
I wonder if we're gonna ever go back into that sort of low interest rate environment again. Where the Bank of Canada is just gonna be like, the economy's not doing so good, so we're just gonna sort of leave it as is. Like, I wonder if that's ever coming back again. I'm curious.
So I think back in the 1980s and in 1990s, when wage inflation was a lot higher than what wage inflation is now today. So there was a lot more justification by the Bank of Canada to continue to raise rates back then than there is now.
And this is when we had manufacturing, right?
Manufacturing was a big boom in manufacturing. Nowadays, we're in a global economy, Amazon-style competition. Labor market is not seeing as high of wage inflation as we did in the past. So I don't see increases in interest rates going past the 5% mark. We're at record levels of debt in the economy. For the Bank of Canada to just continue to raise rates past the 5% range, I just don't see it.
5% seems to be the threshold, huh, for you, that you think?
Yeah, I would generally say so, but if, the Bank of Canada is going to continuously monitor interest rates and economic data based on what's happening with interest rates. Bank of Canada said they're going to watch data very carefully.
I want to thank Richard Tartaglia for being on the show again. He's always been a very helpful contributor. He's also written a blog article about this as well if you guys are into the reading. It's posted on his site, it's posted on my site. I'll set up the link in the video. And, we hope you guys have a fantastic 2018. And Richard and I will probably be doing a presentation, a seminar where you can ask questions to us directly. So we will announce that date probably very soon. And we'll do a promotion and a campaign for that as well too, so that you can meet us in person.
Thanks for having me on again on the show.
Okay.
And yeah, I mean, last time it was great to hear from people from YouTube. They just call me up and I saw you on YouTube. It's cool to see how things have really panned out.
We strive to offer value. We strive to give people a little bit more clarity and insight, and even though you may not believe what we're saying because you think something differently, it's always good to have different perspectives, right guys? So if you need help this year, give us a shout. Great opportunities in certain segments of the market. So if you want to know more about that, then hit us up, send us an email, give us a call, and we'd be happy to help you out. See you guys. Thanks a lot, Rich, and we'll talk soon, guys. Bye, guys. So in the hip hop community, he's known as Richie Teabags.
Teabags!